and welcome to Samvat 2073. What a special year it has been. Firecracker of sorts, but not quite the bomb. A 14% rise in the Nifty, better traction for the broader markets, and more importantly, the markets have had to deal with just so much. Back home, we've had a new governor at the RBI. We've had Brexit this year, and then, of course, a rock bottom for the market, sub 8,000, and then we've risen like an albatross.
There are two trends which, to my mind, they stand out. Number one, the rally in mid and small cap stocks, which continues, and the way domestic flows have really made a comeback. For the first time, we can say that Indians are endorsing equity as an asset class. So it's no longer a one-trick pony that we're only dependent on global flows, but domestic flows are also making a comeback. So on that note, let me welcome our experts now. Smair Arora joins us from Singapore. Hiren with Alchemy and Nilesh Shah of Envision, they both join us in our Mumbai studio. Gentlemen, happy Diwali to all three of you, and thank you for joining us. Smair, let me first talk about the global view. Now, the Samvat year gone by was all about global imbalances, and yet Indian markets managed to climb the wall of worry.
But so did the world. It's not that India outperformed any significant market or by any significant margin. And so therefore it was not that India climbed, the whole world did, and that is because you have no choice. We were told in the past to compare interest rates to earning yield, and now we can justify by just comparing to dividend yield. Not in India, but I'm saying in the US and all. So for interest rates to be zero, there is a lot of a credible case you can make that people have no choice and therefore they will go into equities, and they are.
Well, quite a few bulls out there in Smair's backdrop. Hiren, let me come to you. Is it going to be the return of the bull this year? Next Diwali, are we going to be talking about 10,000 plus levels on the markets?
Let's keep it in perspective. I think that 2014-15 Diwali was a great year. So you obviously had you still have a positive year, but you don't have as positive a year as the previous year because you got a lot of the returns front-ended, and you can have a consolidation year in between, which I think was the year that just went by. I do believe we are seeing a cyclical turnaround in the economy, and hopefully earnings downgrades have bottomed out. Yes, we've not seen a substantial spike in earnings, but I think the direction is clearly up. And markets, as they are, I think they tend to discount the future well in advance. So I think that as economic activity picks up and earnings pick up into the second half of this year and next year, you should see a good returns from the markets. However, I think the challenge will come is the call that while in India the cost of capital is clearly falling, because interest rates are heading down, we don't know what's going to happen globally. So if we have two opposing forces, so let's say if interest rates harden globally, but they fall and then they don't fall any further in India, then we may have a slightly different context in the next year. But otherwise, I think generally speaking, if earnings are going to go up and cost of capital is going to come down, that is only going to be good for equities.
Nilesh, that's the good, but is that the big worry really? What happens on a global front?
I think that's going to be the cardinal issue, I think, for the next year or so, because we've really lived and thrived in an environment of virtually no cost of capital, abundant liquidity, infinite support from the central bankers, so to say. And I think they have started pondering whether this ammunition that we have unrolled into the financial markets, is this working enough? Is this good enough? Is it time to roll back? I think that's going to be the single biggest debate in the next 12 months, and that's something which will decide the course of our markets as well. But I think back home, things are only going to, it looks that they'll get better from here. And if you ask me, I think two important events to watch out for: the course of our own Reserve Bank of India in terms of interest rates, how down do they go further, and two is the outcome of the UP elections, and does that propel the government to kind of get back into a growth mode or in an expansionary mode. I think these two will be the two biggest important events to really watch out for.
Smair, I distinctly remember when the subprime crisis broke out in 2007, we used the word decoupling. And again, we are revisiting that theory saying that world is in a mess and India is moving differently. But the 2008 experience, Samir, has taught us that there's nothing called decoupling. Indian markets or Indian economy will have to align with global factors. And globally, I'm afraid, Samir, there is a lot of mess.
So nobody's building a case of decoupling anymore, because as I was saying, the world itself has done well this year. So why are we even thinking that we are in some island? We maybe next year in an island, we'll see when it happens. But broadly, India has not outperformed anybody. We have outperformed, means the participant may have outperformed because we all bought mid caps and all that. But if you look at index, it's been a shocker actually. India is a good relative choice. But if the world falls for various reasons, then India will also fall. Personally, for me, in my non-India portfolio and everywhere else, there is nothing to be made in fixed income. Therefore, interest rate may go up, but it's not going to still make fixed income investment more attractive relative to equity.
IT and pharma, the performing groups, they are taking a backseat. A stock like HUL has corrected from 1,000 rupees to about 850 rupees. And if I look at a stock like State Bank of India or other NBFCs, it's been leadership clearly is shifting.
Yes, I think that's characteristic of any kind of a bull market or a market cycle, so to say. This was really a market which was initially started off where investors were willing to pay premium for quality. This was about investing in balance sheets, investing in cash flows, even if the growth was kind of, on the lower side, but I think investors were fine with that. In a way, I'd say that in the last 1 year, it's been more a risk on trade, which seems to have kind of gotten ahead. The fact that commodities have done so well. A lot of cyclicals, like chemicals, they have done well. Sugar stocks have done well. So the last 1 year, there's clearly been a change in leadership. How sustainable is this change in leadership? I'm not quite sure about that. But that's a reality where beaten down, rate sensitive, cyclicals, they have donned the mantle of leadership as far as the market goes. And because you see these kind of sectors getting more representation in the mid-cap index, that you see so much of difference between the performance of the large cap and the mid-cap. However, given the kind of price appreciation that we've seen, I think now these kind of sectors are virtually priced to perfection. Assuming that commodity prices will remain at elevated levels, the chemical cycle will remain so benign, and all of that. I'm not too sure whether this will sustain itself even in the next year or so.
Samir, what is your thought? I mean, this year has been all about autos and everything to do with autos, all ancillaries, be it tires, be it batteries, etc. And then, of course, dots of sugar, specialty chemicals and NBFCs. How sustainable does this rally in these sectors look to you?
Well, we've only had autos and NBFCs and private sector financials, so it's been okay. In general, I would think that the rally in everything has been a bit fast, and basically we ignore everything these days in sectors where either there is a little bit of growth or where the promise is that because rains have come, suddenly something will change next quarter. We can have change of chairmanship, we can have poor guidance, as long as, not poor guidance, but basically where the results have been poor, but you can guide better. People have given them benefit of doubt. That is what I mean by flow of money. I feel that the small caps and mid caps have gone up too much too fast. And basically, although for many of them, you could say, could say even for ones we own that they are justified. But just from a big picture angle, I don't think that everything is justified just because it has gone up. So I think it will be more, although I also agree that the large caps are really stalling and many of them justifiably so. But it is not as easy as it has been the last 3 years where people have bought, because basically they are starting their lives in 2013 or 2012. They think that everybody is looking for a 50 bagger and a 100 bagger, at least what I see on Twitter.
Twitter's getting a source of information, isn't it? Okay, it's not going to be as easy as it has been in the last year to make money in sectors that we just discussed, specialty chemicals, NBFCs and autos. So where can one make money in the year ahead? We're going to discuss that, but after this very quick break. Samvat 2073 with our three wise men, Nilesh, Shah, Hiren, as well as Samir, Arora. It's been a bifurcated market that we've had at our hands. The year gone by, autos, ancillaries, it's been sugar, it's been NBFCs, specialty chemicals. They've all done well. But is it going to be as easy to make money in the next year to come? Or would you want to rethink now your investments in the sectors that I just mentioned? Hiren, what is your sense? Is it time to go back to the drawing board, perhaps profit take from some of these names if you haven't already?
No, I think, leadership is not going to change so easily, right? So I think that private banks, NBFCs will continue to lead. Autos will continue to. I think consumer discretionary and private financials will continue to lead. There could be other sectors that could join in. And I think within a year, you have many mini cycles, sector rotations. So I think on a relative basis, I believe that probably the small and mid caps are, in a relative sense, more expensive than large caps. So there might be a phase in the future where they go through a correction consolidation before they make the next move. And I think that relative to else, I think large caps will do well. I particularly feel that large cap pharma is a good area from a risk reward perspective where money could be made. I think they've gone through a year and a half of correction and consolidation with all the US FDA issues and so on and so forth. And slowly and steadily, I think each company should probably start emerging out of that over the next 6 to 12 months. So I think that's one pocket where there is secular growth, but we've seen a correction and consolidation. So I think the risk reward is far better.
Okay, so let's talk about NBFCs. Where do you think money will be made in NBFCs? I'm not giving you the option to talk about Bajaj Finance because by now even your teenage son knows that you've invested in Bajaj Finance. So let's talk about something which our viewers don't know.
Has he?
No, I think in general all NBFCs will do well, but there's one particular area within NBFCs which is the microfinance, which I think is still in a very strong growth phase. And I think that the opinion is still divided on the street. And to my mind, therefore, that makes a case for a continuous re-rating because growth is going to be strong, at least for the next couple of years. And, there is still scope for strong returns to be made there. So I think within the NBFC subsector, I think there is money to be made in microfinance.
I can think of 3 or 4 names in NBFCs.
Yeah. Hiren talked about, which these guys are never going to agree to, they won't mention names. But Hiren talked about that this year perhaps could be a year where pharma makes a comeback. Since you're a keen observer of IT, do you get that sense at all that IT could make a comeback? Perhaps this could be the transition year? Or do you think again a year and we're going to see those painful, awful profit warnings coming in from the large caps?
I think IT or technology, I think is pretty interestingly poised. It's somewhere around, how the consumer sector was 5 or 7 years back. 5 or 7 years back, you could really look at the top 2-3 consumer names, HUL, ITC, and take a view or come to a conclusion that this is a no growth area. And you could have just kind of given the whole sector a pass. In the process, you could have overlooked, maybe dozens of consumer companies out there who've done exceptionally well and have created tremendous wealth. I think something similar, it's quite possible in technology where the big guys have become so big, they become multi-billion-dollar companies that it's very difficult for them to generate the delta in terms of change. And they could remain in that sub 10% growth rate for a very extended period of time. Versus that, you have the smaller set of companies who are doing something very niche, who have carved their domain strengths, probably with just 1 or 2 acquisitions here and there, their size could even go bigger, and they could move much more faster versus the big boys. And maybe that's where a lot of the upside could lie.
But Nilesh, if you look at the definition of large cap IT, irrespective of the 4-5 cycles we've seen in the last 20 years, the definition of large cap IT is still TCS, Infosys, HCL Tech and Wipro. So irrespective of the mid-cap IT case and domain knowledge and expertise, mid-cap IT has never made a lot of money or shareholder wealth in the last 20 years.
And that's because for bulk of these 20 years, the business has been the conventional business, which is the AMD business, application maintenance development, where you go to a big enterprise, big client, and talk to them about multi-year, multi-billion-dollar transactions and things of that kind. I think that now is kind of history. I'm not saying that's going to vanish, but that's a bit of history. The whole technology space has changed, evolved, transformed to much smaller duration projects, much smaller duration work, very defined work, and that's where really the opportunity is. And I think that change is something which now the smaller companies or the mid-tier IT companies probably can kind of make the most of versus the big boys. The big boys will do it, but it won't move the needle for them. Whereas for the smaller guys, I think it will move the needle. So I think the nature of work itself, the nature of engagement, I think that itself has gone a huge change. And I think something similar to what happened in the consumer space over the last 5-7 years, where individual categories did so well that actually companies which are just running one product or one category did exceptionally well in the consumer space. I think that's quite possible in the technology space.
Sameer, you've always been a votary of the IT space, and you identified the space 20 years ago. Now there is an issue, there is a challenge, and there's a disruption. So do you think one should now actually remain underweight on IT as a sector, as a commitment?
I have my biggest weight in financials and in NBFCs and private sector banks, and I think that will go on for a long time, because it's an easy way to get consumer discretionary financing, mortgage financing, microfinance and stuff like that. So I think that is the easiest one, where if we are talking about interest rates being lower, inflation being in control, where we talk about NPS being recognized, some being recovered, whatever. Technology, I must say that for the first time since 1993, we have 0 longs and a few shorts. So forget about shorts. Even on the long side, we don't have a single stock, because we like to work a little less and we like less effort. And where the pain of finding something which will grow in this thing is a bit difficult for us. So we have 0 stocks right now. And we plan to be at 0 because we are right now short. So first we have to cover those maybe in the next 6-9 months.
What about small cap versus mid cap debate? That is the favorite debate. I can make a case that small caps are expensive, but they're growing. I can also give you data which will prove that large cap is where the growth is, and large cap is where the interest rate cut benefits would kick in.
See, I think there are 2 or 3 things. At a very macro level, we have to understand that 2013 August, September, during the lows of the market, the Nifty mid-cap index was trading at a 650 basis point discount to Nifty. Today, it's completely the reverse. It's trading at 650 basis point premium to the Nifty. Okay? And the average discount over a 10-15 year period has been about 150 basis discount. The only time, a short period of while in the previous cycle, when the mid-cap index traded at a premium to large-cap index was when earnings were growing at 30% compounded, right? Now, if you have to deconstruct this, I'm not saying that therefore all small and mid-caps are unworthy of the rally that they've had. But I think that on a relative basis, there is probably some point to ponder that probably till earnings catch up, or the problem also has been that the large cap index in Nifty virtually gets 40-50% of its earnings outside of India. And there have been challenges on currency, there has been challenges on growth in IT, plus the large PSU banks have created a negative delta in the aggregate profits of the large cap companies. And that is one reason why the growth overall in the large cap profitability has kind of negated. You've had big growth in companies like private banks and Maruti, which has been taken away by the PSU banks. So I think that there could be some balancing out that might happen there. I think in the medium term, there is possibly a case for large caps to outbeat the small and mid caps.
Really short answer, the mega trend for the year ahead.
I think the mega trend which has been playing out will continue. I still think equities, will do well. The big difference could be that maybe the next 1 year, it's quite possible the large cap as an index could actually do as well as the mid cap index. I'm not quite sure if the mid cap index, say for the next 1 year.
You want to work hard.
No, I think if you're talking of the next 1 year, but if you took a slightly more medium to long term trend, I still think the case for mid caps or small caps remains. because as we all know, India is a stock pickers market. So I think that will continue to play. It's just that right now as an index, the mid-cap index is trading at a premium, and it's quite possible that over the next 1 year, some of the big boys catch up. And,
so that one nifty name which is going to be at the helm of the leadership?
No, I think there could be many names. It's quite possible that Reliance could surprise us over the next 1 year. It's quite possible that the two big PSU boys, the ONGC and Coal India, they could surprise us. And it's quite possible over the next 1 year, Infosys, TCS also could surprise us. So these are the 6 names. I mean, out of 30 names or 40 or 50 names, you have these 5 or 6 names. It's hard to kind of really say one name, but I think there could be 5 or 6 names, a half a dozen names, which could positively surprise us. It doesn't mean that the long-term trajectory of these companies is changing, but it's just that these set of companies have, as stocks, have underperformed. And it's quite possible that that underperformance could kind of give up in the next 1 year. And you could have some kind of positive absolute returns in the next 1 year.
Nilesh, Hiren, that one stock which could be the bomb for the year ahead.
I won't give you a one stock, but I think the two. No,
you can give us 50.
The two. I think the two biggest contenders from where a nifty winner could come would be either from large cap pharma or a PSU banking space, according to me.
And you say 99% of the stocks you don't know, but that 1% you know you buy with a lot of conviction. What was your last acquisition in the funds you manage?
I think one of the most recent ones that we've bought is IDFC Bank.
Okay.
I think that's what we clearly believe in terms of financial inclusion. I think financial inclusion is a reality. I think we like the pedigree, we like what they are currently doing, their aspiration to become a mass retail bank. It's not, of course, going to be an easy process. It's not a 1 quarter story. It's not going to kind of deliver linear growth. But I think over the next 3 to 5 years, I think IDFC Bank has a very strong set of opportunity to pursue. And we think that they would be able to execute over the next 3 to 5 years. So we just thought that on a relative basis, even the valuations were super attractive a quarter back when it was trading at less than 1.5 times price to book, versus most of the private sector peers trading north of 3 times price to book. So I think, and we continue to remain excited about what IDFC Bank could potentially do over the next 3 to 5 years.
It's a Samvat show, so I didn't name from you. What was your last acquisition?
It's in the large cap pharma space. I'm not going to give you anything.
Large cap pharma, give me a
Does it start with an A?
It's a Samvat show. It's a different show. Happens once in a year.
Well, it's Lupin. Okay. And full disclosure that,
we respect that.
Yeah.
So fantastic. You heard it from the 3 wise men. It's Lupin from Hiren, and it is IDFC Bank from Nilesh, and Samir for the first time in last 20 years. He's zero IT and short IT.
Because he doesn't want to work as much. Okay, on that note, we're going to wrap it up with this edition of Samvat 2073. And here's wishing all our viewers a very happy Diwali from us.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.